companies drowning in debt, but their stock is soaring. It seems bizarre, but it's more common than you think. Expose the hidden dangers lurking beneath the surface of seemingly successful businesses, and learn how to protect your investments in our breakdown of how stocks really work. So what exactly are stocks? Simply put, a stock is a share of ownership in a company. When you buy a stock, you're buying a small piece of that company. Think of it like this. Imagine a company needs money to grow. They might sell stocks to raise capital. These stocks are also called shares or equity. The people who buy these stocks become shareholders, owning a portion of the corporation. Now, how does it all work? Companies issue stock on the market, and the price of that stock is based on supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell, the price goes down. This constant buying and selling happens on stock exchanges, like the New York Stock Exchange, NYSE, or the NASDAQ. These exchanges provide a platform for investors and traders to buy and sell stocks easily. Why do people invest in stocks? Well, there are a couple of reasons. One is dividends. Some companies share a portion of their profits with their shareholders in the form of dividends. Another way to profit is through capital appreciation. If a company does well, its stock price may increase, and you can sell your shares for a profit. Or companies issuing stock is a way to raise money without having to borrow it. This capital can be used to expand their business, develop new products, or pay off debt. However, it's important to remember that investing in stocks comes with risks. Stock prices can go down as well as up. You could lose money on your investments. This fluctuation in price is called volatility. Factors like the company's performance, overall market conditions, and even news events can affect stock prices. That's why it's important to diversify your portfolio. Don't put all your eggs in one basket. There are different types of stocks to consider. Common stock gives you voting rights in the company. Preferred stock usually doesn't have voting rights, but may pay a higher dividend. You can also categorize stocks as growth stocks, companies expected to grow quickly, or value stocks, companies that may be undervalued by the market. Successful investing involves research and understanding financial reports. Investors often look at things like a company's revenue, earnings, debt, and management strategy to make informed decisions. There are also different investment strategies, such as long-term investing, day trading, and value investing. To buy and sell stocks, you'll need a brokerage account. There are many online platforms and brokers that offer access to the stock market. They act as intermediaries between you and the exchange. Before you invest, it's crucial to do your own research, understand your risk tolerance, and consider seeking advice from a financial analyst. Look at a company's financial reports and learn more about the market conditions of companies on exchanges like the Dow Jones, FTSE, and S&P. Of course, this video only scratches the surface of the stock market. We haven't touched on more complex topics like options trading, futures, or the impact of global economic events like booms, recessions, and inflation on stock prices. Also, we have not considered zero-coupon stocks at all during the production of the video. If you want to delve deeper into these areas, let us know in the comments. And if you found this video helpful, please give it a like, share it with your friends, and subscribe for more educational content. Thanks for watching.